go down a lot before it actually goes up. Okay, so now I have a question for you, right? So if a fundamentally strong stock can go down and an undervalued stock can also go down, why do we want to buy undervalued and fundamentally strong stock? If the reality is that it can go up or it can go down, so why? Why do we still want to like buy strong stocks, undervalued stocks? Why? Or good stocks and undervalued prices? If the reality is that it can still go up or down, it's almost like a toss coin, right? Coin toss. So why? Why would we still do it? Okay, so Ray say long term will go up eventually. Chances of going up is higher. Okay, long term value investment. All right, correct. Okay, all these views are correct, or at least I agree with you. Okay, is that usually fundamental analysis is used for long term, and long term we mean many years. Okay, many years, right? And which means in the short term, okay, using fundamental analysis, I hope you can see from now, fundamental analysis, if you try to use it for short-term purposes, it doesn't work that well. Okay, because in the short term, it can go either way, right? It's 50-50 one. Okay, so why do you want to, if let's say you're trading short term, right? Why do you want to do so much analysis in terms of fundamental analysis? Okay, because it has no bearing on the immediate outcome of the stock. Okay, so you are just doing extra things for nothing. Okay, so I hope you see the point. So fundamental analysis is mainly used for long term, and long term means you must be prepared to hold for many years for the thesis to unfold itself. Your thesis, your investment thesis to unfold, right? It cannot be just the next few weeks and next few months you start to judge the reality. Okay? But your expectation is wrong in the first place, and the tools that you use to analyze a stock for short-term positions is also wrong. Yeah, so I hope you get what I'm trying to say. So these are some examples, right? So for example, Alibaba, it can be undervalued, but you can see the share price can range bound for 2 years already, going pretty much nowhere. Okay, if you do fundamental analysis, you do valuation, you realize that yeah, it's undervalued. Okay, but this is my point, right? You cannot use fundamental analysis for short term. It's not useful at all. And this is PayPal, right? It's not just China stock. You can see even well-known US stock. Same thing, range bound. Maybe it's shorter, maybe 1.5 years. Okay, but you get the drift, right? Okay, can be Disney, right? The range is a bit broader, right? Because they have some spikes over here, but you can still see that it's pretty much going nowhere for the past 2 years as well. Okay, and it also can be dividend stock, undervalued stock. For example, Hong Kong Land, the book value is at $14, and you can see for the past 10 years, the share price have never traded above $6. Perpetually, the share price is 50% undervalued, sometimes even more. Okay, and this is inclusive of dividend. That means that you collected dividend for the past 10 years, you hold the stock, you are still down 18%. Okay, so sometimes even you do long term, the outcome may not turn out as what you want it to be. Okay, so be it, right? So that is part and parcel of investing. It's never 100%, no matter what strategy you use. All right, I just want to paint that reality to you, and you need to understand and accept this reality. Okay, another expectation is that a lot of people buy the stock, right? They expect every stock to make money. Correct? Otherwise, if you know that you don't know whether you make money, you will not buy, right? Okay, so most people buy with expectation that they will make money on every stock. But the truth is, nobody's 100%. Okay, not even Warren Buffett. Right? So realization is, what good is fundamentally strong stock if the share price doesn't go up? Important, correct? Yes, you want fundamentally strong stock, you want undervalued stock, buying and holding over long term, but if the share price doesn't go up, when is the point that you say that it's not going to happen? When is the point that you say that you're going to sell it? When is the point that you're going to say that I'm going to switch to another stock that have probably a better opportunity? When is that decision point? Okay, as we said, yes, we may not get the right stock all the time, but correcting your cost is a very understated investment action that most investors missed out. Okay, they usually just buy and just freeze there and don't know what to do. Okay, you cannot afford to do that. You need to correct costs along the way. All right. As we go along, I'll unfold more of these insights to you. So the next thing I want to bring in is we want to reverse certain things. Okay, we want to reverse certain things, right? What it means undervalued stock. Okay, so of course it depends. It's just basically, let's say the value is $2 and the price is $1. Okay, this is what we call undervalued stock, right? The subjective part is how do you determine this value? Okay, and there are many different methods, okay, which we will not delve into today. We're just going to focus more on trading aspect rather than investment aspect. Okay, but I want to draw your attention that sometimes you may use a long-term strategy for short-term purposes, which is not suitable, right? So that was the first part that I want to drive across. And now let's move deeper into then how do we approach the market if we want to trade short-term, if we want to hold a stock for weeks to months. Okay, so I'm giving you that time frame, right? We're not going to hold the stock for over years. Okay, also given you the clue that fundamental analysis is not useful if your holding period is short. Okay, so in this case, based on this holding period of weeks to months, which stock do you think is a better buy? Stock A or stock B? Okay, stock B, correct. Right? So if your holding period is shorter, it's important that you go along with the trend. Okay, so sometimes you hear people say the trend is your friend. Okay, if you hear that, you know that it's a trend follower kind of investor or trader, a momentum trader, and it's typically short term, okay, perspective, right? This stock A is typically a long-term investor kind of setup, right? They want to wait for the share price to go down, and let's say the value is here and the price is below, then that's where they buy. Okay, and then they will hold for many years for the share price to eventually rebound. Okay, but if your holding period is just weeks to months, you have no time. You don't have enough time for the stock to turn around. Okay, it's too long already. You rather buy a stock that is already moving up, and in the next few weeks or months, there's a tendency the share price will move in the same direction. Okay, I'm just saying tendency, I'm not saying 100%. Okay, and this is what we call the momentum effect. Okay, maybe you don't get a full picture yet, but let me ask you, have you experienced this before? You saw a stock come down, and then you feel that it's undervalued or cheap, you buy. Okay, understand, right? Simple. Then after that, the stock went down further. Have you experienced this before? Have you experienced this before? Yes, right? Very common, right? Okay. Next one. You saw the stock go up. You wanted to buy, but you feel that it's too expensive. So you say, don't buy. Wait first. Wait for the share price to come down. Then instead of the share price coming down, it continued to go up without you. Anyone experienced this before? Yes, as well, right? Okay. So these two are examples of momentum effect. Okay, this momentum effect is very simple to understand. If the stock price is going one direction, momentum effect is saying that it's very likely that the share price will continue in the same direction. Okay. Therefore, this is what people say, don't catch a falling knife because you don't know where the bottom is. Okay. Only when the share price rebound convincingly, then you know where the bottom is. But when it's going down, you think this is bottom, you think this is bottom, you think this is bottom, it may be lower and lower, you see? Right? So you must respect the effect of momentum in the short term because share price tend to have the energy to move in the same direction for a period of time before they reverse. Okay. Same thing, if it's going up, the tendency is for the share price to go up further. Right? And the important realization is this, okay? If you want to trade short term, you don't need to care about valuation. Valuation is a long-term concept. It's not a short-term concept. Valuation is only important in long term. Valuation is useless in short term. So you don't think in terms of the stock is cheap, because what is cheap can become cheaper in the short term. You don't think in terms of what is expensive, because what is expensive can be even more expensive in the short term. Okay, so the biggest thing that you need to understand from this momentum effect is, if you want to trade short term, and short term is defined by weeks to months, go with the same direction. Buy stock that are already going up. Don't go against the tide. And the concept can be seen in nature. Okay, let me ask you, if you're rowing a boat, which scenario is easier? Scenario A, against the current. Scenario B, with the current. Which is easier, A or B? Not a trick question, okay? B is easier, right? It's the same concept, okay? Nature teaches us a lot of things, and the financial markets, even though it's a human construct, is also part of nature, because we are natural beings and we have a lot of all these biases and tendency that get reflected in the stock market, right? So it's the same concept. It's very hard to fight against the current, because the current is much bigger than us. Your boat is just one small item in a vast ocean or sea, okay? Same thing, when you buy or sell a stock, you are just one drop of water droplet in the entire market. You are not going to impact the market that much, but rather the market will impact you more than you impact the market, correct? So don't go against the market in the short term. Go with the market. Then let the market carry your position upwards. It's a very simple concept, but a lot of people can't do it, because they still harbor that, oh, this is expensive, this is cheap, you know. They still get clouded by a lot of all that valuation concept that's meant for long term, not meant for short term. Okay, so the idea is, if you want to trade short term, it's better to use momentum, right? Go with the flow, buy a stock that's already moving up. Okay, yeah. Then the next thing that we will open up another can of worm. Okay, another can of worm is that, how then do we measure momentum, right? For example, this is Apple chart. This is Microsoft chart. Which has a stronger momentum? Okay, it can be subjective, because it depends on how you analyze the chart, how you see the chart, how you cut the periods. So different traders may have different kind of understanding, or kind of a different kind of conclusion, basically. Okay, and there is a more objective way to measure momentum, right? And this is something we learn in school. It's called regression, or you can say the best fit line, right? If you recall, what we done in school is that we give a graph paper in a lab. We will measure the apparatus, vary the measurement, and then we will plot on the graph paper. Okay, and those dots, right, is not in line, right? It is off a little bit. Okay, then what we do is that we draw a best fit line that cuts through the plots. And then once we do that, we will be able to measure the gradient, which will be the relationship between the um, uh, variables. Okay, and what's the purpose of this? The purpose of this is that, if we can measure the gradient, for example, we can measure the gradient, right? We can draw a best fit line on the stock chart. We will know the gradient, which is the steepness of the slope, right? Okay, and with this number, we can then compare them. Who has a steeper slope? The one that has a steeper slope is the one that has a higher momentum. So if we have two comparisons, stock A and B, okay, the one, in this case, stock A has a steeper slope. This is the one with the higher momentum. All right, so that concept is called a regression method. Okay, using the gradient to measure the momentum of a stock. Okay, and the next thing I want to share with you is that we don't usually use a line, because a line is not responsive. The trend can change and the line is still pointing upwards. Okay, it's a lagging indicator. So we want it to be more responsive, we use a curve. A curve is also known as exponential. Okay, an exponential equation, right? So a curve will respond to the changes more rapidly. So if the stock changes direction, okay, the curve will respond faster as compared to a line. Okay, that's the purpose, right? And how do you read the regression? Okay, there is an indicator called exponential regression. And for example, you read off is a histogram. Okay, so you can just imagine it's a curve, right? Yeah, I can see it's a curve. Okay, it's not a line. And the latest regression at that point in time, which was screenshot around in March, for example, this PDD was at 80%. Okay, so it's measured in percentage, right? Then Alibaba is at minus 24%. So it's very clear that PDD have a higher momentum than Alibaba, right? So if you are given a choice, okay, only these two stocks to buy, then you will know that in the short term, it's better to go with PDD because it has more momentum on the upside than Alibaba. Okay, understand? That's how you use this momentum. And this is another example. For this is cosmetics, right? Just now it's e-commerce. Elf is a cosmetic company. Estee Lauder is also another cosmetic company. So let's say again, you are only given these two stocks to buy. Okay, no other stocks to buy. Okay, you're comparing these two. Trading the short term, it's better to buy Elf because the exponential regression is very high at 457%, while Estee Lauder is at 2.3% only. Okay, and it doesn't take a genius to know, right? You see, this is going up, this is going down. Same concept that we said just now. It's important to go with the flow, not against the flow. Okay. But honestly speaking, I can tell you, most of you will find that this is very uncomfortable because the stock have gone up so many times already. Correct now. It makes you feel that it's very high. Correct? You feel that this is more comfortable because this feels is cheap. Okay, always remember, valuation is not important in the short term. Okay, what is low can be lower, what is high can be higher. Right? People can keep saying, "Oh, expensive, expensive." You just keep going higher, expensive, expensive, expensive. Right? Yeah, it came down a bit, but then it continue its journey. Okay, this one they say is cheap, 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 cheap. You go become cheaper and cheaper. Okay, so the idea is you're not holding the stock over a long period of time. You're just holding in the short term, weeks to months. It's always, always better to go with the flow. That is the most important thing that you remember. Okay. This is McDonald's regression at minus 14%. Wingstop, another fast food restaurant, is at 229%. Okay. So you go with Wingstop rather than McDonald's, for example. Right, same thing, Coca-Cola, there's regression is very low, 2%, there is no momentum. And you can also see in the stock chart is sideways. Okay, not that it cannot go up or down, but you rather go with a stock that has more energy. It can carry you further than stuck with a stock that's not going anywhere. Okay, because time is money, there's opportunity cost. If you go into one stock, means that you will give up opportunity in another one. Right? So that is the technical aspect or the technical analysis. Okay, so this regression concept is a technical analysis, technical indicator. The next thing is that we just now started talking about fundamentals, and I told you that fundamentals or valuation is not important in the short term. Okay, but fundamentals can still play a part in the short term, just that you need to use it properly. Okay, in the short term, what kind of fundamentals will cause the share price to move up? Okay, the key would be the revenue or earnings growth, especially during the earnings period. Sometimes, especially in the US, right? The US stocks. During earnings season, the share price can get up or down. Gap up means that the share price may be trading at say don't know, $1, $100, then suddenly it jumped to $110. Okay, so there is a gap. And usually that day is an earnings day. Okay, and why is there a gap? This gap is caused by fundamentals. It could be the company announce better results, earnings surprise. It can be better guidance going forward, right? But whatever it is related to the fundamentals of the business. The things have improved, right? Or the outlooks have improved, or the results are better than expected. Therefore, the share price must go up to fill up that expectation gap. Okay, so fundamentals can still play a part, and the best way to use fundamentals is to look for this momentum in fundamentals as well. Okay, so the momentum concept don't just use in technicals, you can also use it in fundamentals. And what do I mean by that? If a share price, the concept is if share price is going up, momentum say that it's likely to go in the same direction, correct? So same thing, if there is revenue growth, if there's revenue growth in the previous quarter, the momentum can carry more growth in the future quarters. Okay, so one is a technical analysis momentum, one is a fundamental analysis momentum. Okay, but the concept is the same. That means you do want to see stocks or companies that have in recent quarters reported better results, in recent quarters that have shown quarter-on-quarter growth, whether in revenue or earnings, that will increase your chances that the future quarters will be better as well. Okay, because there is momentum in the fundamentals, fundamental improvement in this case. Okay, it doesn't matter whether is it growth stock or whether is it value stock, right? Any stock that exhibit this sudden surge in growth of revenue or earnings, you'll see the share price do very well. Okay, so fundamentals can still be used, but it must be used specifically with relation to revenue and earnings in the short term on quarter-to-quarter basis. And in this case, momentum is also an effective concept to apply on fundamentals, not just on technical analysis. Okay, so when you have this momentum in fundamentals, they also tend to produce earning surprises, and the share price will tend to spike upon result release. Right, then you also have more confidence that to hold through the earnings season. Okay, although not all earnings season can be held through, right? Caveat. Okay, but I just want to share with the concept. This is the fundamentals. This is the revenue. Okay, you can see every quarter, every 3 months, they will have a new number. Every 3 months, they have a new number, and every 3 months, they have a new number. And you can see that consistently, the revenue has been growing quarter on quarter. Right? And you can see that the momentum carries on. Okay, so this E is the earnings date. You can see there's a gap. This is what I mean. This is a gap up. Okay, then gap up. This is also earnings day. There's a gap up. Right, and then let's look at the latest one, okay, which was actually at the start of the year, at the time that I print screen this. Wait, I don't have. Yeah, actually have. It's here. There's also another gap up. Okay, this orange line is the opening price. Okay, so you can see the gap up. Right? And this is another example. Revenue has also been climbing. And in fact, the gaps is widening. That means there's acceleration in the revenue growth. Earnings, gap up. Earnings, gap up. Earnings. Let's look at the next one. Gap up. Plus 18% after result release. Okay, so the concept is that fundamental momentum exists too in the short term. So anything that's short term, just use the concept of momentum, you'll be fine. Whether is it technicals, whether is it fundamentals. Okay, it's not the very conventional way that you do valuation, you look at I don't know, quality of the business, the mode, the management, all these kind of things. It's not important in the short term. Is that momentum concept, what can drive the share price in the short term that matters. Okay, so make use of both. Don't use FA or TA alone. Combine both to increase your probability. FA will help TA to be more reliable. There must be a reason why the share price is going up, right? And usually it's a business improvement in the short term, right? There's fundamental improvement. And the TA also confirm FA is correct, because we started this session with saying that, yeah, you can buy a fundamentally strong stock, but it doesn't mean you go up, right? It will go down. It can go down. The undervalued stock can go down even further. So by applying technical analysis to make sure that the share price is moving up, then you have the case where you are buying good stocks that are going up, applying both FA and TA. Okay, the concept is very simple, right? But of course, not many people can catch that because there's just too much noises nowadays. Okay, everybody say this is better, that is better. The issue is that is the context that you're going to apply the methodology. Okay, if the context and the methodology don't match, you will end up with the wrong method applied, and that's why you don't get the results. Okay, so if the fundamental is right, shouldn't the stock go up? Okay, that is the important question to ask, especially for short-term trading. Okay, so you should have both to work in your favor, having both fundamental momentum, technical momentum that will increase your win probability. Okay, again, not 100%, but it's all about improving your odds. Right? So we know which stock to buy. It should exhibit both fundamental and technical momentum. Next is to know when is the best time to buy a stock. Okay, I already give you some hint or glimpse of what I meant of catching a falling knife, or what is cheap can become cheaper, right? Fundamental analysis is very bad at market timing. Okay, so for example, let's say you have calculated the value of this stock is at $210. Okay, that means that anything below $210 is undervalued. Correct? At $200 is undervalued, at 180 is undervalued, at 160 undervalued, at 150 undervalued, at 140 undervalued, at 100 is undervalued, at 80 is undervalued. Okay, until $1 also undervalued, until 10 cents is also undervalued. Okay, what is the point here? The point is that you may think that at 180 is cheap because against the value of 210 you buy, then it becomes 160. Okay, then you buy some more, then it becomes 150. Then you think that it cannot go lower, then you buy some more. Right? What is low can keep going lower and lower and lower. Okay. So fundamental analysis is bad at timing because it is a very big range of values to say it's undervalued. And we also said that undervalued stock doesn't mean it'll go up, right? It can still go down further. Okay, right? And a stock, you can lose 100, you can lose 50% many times. Okay, this is also another thing that I want you to remember. Right? So let's say a stock starts at $100, lose 50%, become $50. Lose another 50%, become $25. Okay, can you still lose another 50% from here? Cannot. Cannot. How many times can a stock lose 50%? How many times? 2 times? Still can fall, right? 1250, also lost and 50%. 1250 can become 625, lose and 50%. Can become 317, can become 160. Okay, still can go 80 cents, 40 cents, right? 20 cents. Can you see how it can endless on it? Right? Yeah, it can fall many, many times, 50%. And I think that a lot of people don't realize this. Right? Because they think in terms of, yeah, stock drop 50% already, very cheap already. How far can it drop? But it can drop many times. It can keep halving without going to zero. Okay, that means if someone who bought at $50, right, he thinks that it's cheap after a 50% drop, right, he thinks that it's cheap. Okay, then he hold until $25, he sell. So he realized it's 50%. This guy who bought at $50 is no different from the guy who bought at $100 and sold at $50. Okay, so even though you feel that, I cheaper, I bought $50, that guy bought $100, sell to me at 50. Okay, that guy is dumb. Buy at 100. I buy only at 50. Okay, but if this guy sell at $25, he will still lose the same amount. Okay, so these are important concepts that you must know. And therefore, especially in the short term, you cannot allow this kind of big losses. you don't have enough time to recover because you're only giving weeks to months for the share price to turn around, right? Which usually they won't turn around in that period. You need years. Okay, just now we see some of the examples. It take at least 2 years, right? Example, ARKK, Mandy asked. Same thing, right? ARKK also take years to recover and not even recover back to the highest price yet. Okay, and it's still a question mark whether you recover back to the highest price, right? Okay, so just remember when a stock goes down go down a lot, especially like drop 50%, drop 30%, right? It will not rebound so fast one. Okay, it will take years. You have to be patient if you want to get in. Okay, you really have to look long term. Right? You cannot expect that a stock drop 50%, right? You just buy, you straight away can make 100% in the next few weeks or months. Okay, it doesn't happen that way. Okay, most of the time, you need years for the share price to rebound. Okay, therefore, that is not the smart way to trade the short term. And this is an important stage chart that I want you to remember is created by Stan Weinstein, which is very useful to help you see the big picture of a price structure of a stock. So there are 4 stages as you can see in this chart itself. Stage 1, the share price is not going anywhere. It's sideways, range bound. Okay. Stage 2 is a very clear uptrend. Stage 3 is also range bound. Looks like stage 1, just that stage 3 is high, stage 1 is low. Stage 4 is a clear downtrend. Right? Okay. So let me ask you, if you only buy, you don't short, okay? If you only buy the stock, which stage makes you money? If you only buy the stock, you don't short, which stage actually makes you money? I will say 2, Brian say 1, Tyson say 1 and 2, Chai say 2, early stage 2. Johnson say 1. Yeah, so for those who say 1, right? Okay, let me ask you, at stage 1, right? How long can stage 1 last? Is it days, weeks, months, or years? Okay, or maybe let me rephrase the question. Do you think stage 1 can last for years? Do you think stage 1 can last for years, many years? 4 years, 5 years? Yes, right? So if you go in at stage 1, right, what is the risk? What's the risk? You go in at stage 1, you may think that you buy low, right? But you may be stuck for many years before the share price moves. Correct? Okay, remember we are looking at short term, weeks to months. Okay, so if you are making money weeks to months, and just now I told you the momentum concept, right? Which stage is the best stage to make money in the short term? 1, 2, 3, or 4? Actually, just now you all only choose between 1 or 2 lah, right? So which is better in the short term to make money faster? Stage 2, correct. Okay. Right? We don't short lah, we don't talk about stage 4. Okay, we only long only. We only buy and sell higher. Right? Stage 2 is the only stage that makes money. And it may look very simple, obviously, lah. You talk to me and feel like I'm an idiot, right? Okay. But the concept is very profound, right? The concept is very profound in the sense that only look for stocks that are in stage 2. Only look for stocks that are in stage 2. If the stock is stage 1, don't care. If the stock is stage 2, don't care. If the stock is stage 4, don't care. Okay? You only keep looking at stocks in stage 2 and you trade it. That's it. Because any other stage don't make money. Or you need to wait. Right? Worst is you lose money faster. Okay, so your job is to look for stocks that are in stage 2 use the momentum to help push your share price up. It's as simple as that. Okay? Now, how do you know when stage 2 have begun? Okay, there are actually many indicators, but I'll share with you one simple one. right? Just a simple one. It must at least pass this, okay? This is where we bring in the concept of moving average. It's a technical indicator. You can find it in almost any technical chart, okay? Those who have done technical analysis, you know that this is the first indicator you learn. Not difficult. So it can be, let's use 200 data. That's the most standard one, okay? The longest moving average. Okay? That means the average out 200 days prices, closing prices. So it looks like a curve. In this case, it's the dotted line. Okay. The idea about stage two is that the share price must be above the moving average. If the share price is below the moving average, it's not stage two yet. Okay, so this is a very simple way to determine whether a stock is bull or bear. Right? It must be above in order to consider it to be bullish, and when it's below, it's considered bearish. Right? It's just a cut-off line that is more objective for anyone to follow. Right? So in order for a stock to be in stage two, it must trade, the share price must be above the 200-day moving average. Of course, there are more indicators, but for the interest of time and to simplify, more importantly, get a concept, we will just use this 200-day moving average. Okay, so orientate you a little bit. This red line is the 200-day moving average. Ignore the blue line first. Okay, just look at the red line. Right? So now let's try to map out the stages. Okay, the one I just draw, what stage is this? Okay, because you understand this, then you can see the structure of the stock chart very well already. The one I just draw is stage three, right? It's not stage one because it's at a higher base. It's not at the lower base. Okay, so it's a stage three. How about this? The one I just draw. Correct, four. Okay. How about this? The one that I just draw. I can even extend it actually. One. Okay. Then what about this that I just draw? 1.1. Yeah, 2 lah, right? Of course, the more comfortably the share price is above the red line, which is the 200-day moving average, right? The more obvious that the stage should have begun. And it should be sloping upwards, lah. Right? It should be sloping upwards. Okay, so more importantly, you get the structure right, you can see, right? Although this is a very simple concept, but it's very powerful. It gives you a good framework to know whether a stock is ready for you to buy. Just remember, you need to find them in stage two. Any other stages, waste time. So don't go and buy the stock here. Don't go and buy the stock here. Don't go and buy the stock here. Right? Here looks interesting. Okay. How about this? What stage is this? The one I just drawn. Stage 4, right? It should be obvious, huh? Because it's downtrending. Okay. This stock doesn't seem like it has a stage 1. Maybe if you want to argue that there's one here, then this will be stage 2. Correct. So even if you don't have stage 1, you just skip it, right? It's fine. Okay, so another thing is understand that the stages may not go through the cycle. It may not go through the 1, 2, 3, 4, 1, 2, 3, 4. Okay, life is not so perfect one. Sometimes it jump. Like in this case, there's not really a stage 1. It didn't really consolidate. It's more like a V-shaped recovery, right? It just went down and then it just rebound up. Okay, but the downtrend was a very long time. This is about 2 years. Right? This is 2 years, okay? It's very long. It's painful, right? That's why you buy in stage 4, you're gonna suffer a lot, okay, before you see the daylight. And it's better that you join in stage 2. Makes sense, right? You buy on the way up rather than buy on the way down. Okay. Yeah, this is the daily chart. Usually I just use daily chart. Keep it simple, right? Yeah. I'm not a day trader. So understand that sometimes it may jump stages. Okay. Yeah, you need to, more importantly, you need to know how to read the structure. Okay. What stage is this? practice, I think this maybe one or two more. Four, correct? What stage is this? One. Okay. And you can start to see the red price start to go above the red line, right? And then there's a crossover, and then the share price continue to stay above the red line, and it's upward sloping already. This is stage two. Yeah. So you can see it's better that you let the stock crash finish first. Then once it comes bounce back up, then you start buying. It's the safer way. It's the smarter way. Okay, don't buy on the way down because you don't know where the bottom is. And don't buy at stage one because you don't know how long this can be. It can last for years, going nowhere. So get in at stage two. That's the best stage to make money. Any other stages waste time. Right? More example later. Okay. So just now we have seen, right? We are coming off stage one. Right? All these examples are coming off stage one or coming off stage four. Okay. So sometimes again, life not so perfect. It doesn't mean that you can always spot the transition from one to two that early. Let's say the share price have moved up, right? In stage two, can you still buy or not? That's the question. What do you think? Yes or no? Right. So the share price come back now, stage one, then two, right? Of course, you hope that you buy early, lah, right? Early two. But let's say the share price going to go up. Can you still buy here? Alvin say can, Brian say more risky, Johnson say yes. Okay, the answer is yes. As long as in stage two, we already established that already. As long as stage two, still can buy. You don't know when it will end on. Correct or not? You don't know when the stage two, how long it will last. Nobody know. Okay, nobody know. But as long as the trend is still there, the trend is still intact, it's still bullish, it's still stage two, don't doubt it. Don't doubt it. You still can make money. Right? Okay, I give you examples. Right? For example, right, you have wished that you got in here or even here, right? But now the share price have gone up already, probably up 30-40% already. Okay, at the top right hand corner, $130. How? Buy or wait? Buy or wait? Johnson say buy. Alvin say buy at retracement or support means wait lah, correct? Okay. Richard also wait. How? The rest cannot decide. Yeah, how? Ray also wait. Lovin said, I don't know. Okay. Always remember the concept. Right. Okay, but before we go into the explanation, okay, Brian said, but it can go from stage blah 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 to directly to stage four, right? It looks very scary, right? Yes, obviously it can be. But remember, that's why we still have the next part, knowing when to sell. The problem is people don't know when to sell, they get stuck with a stock that's going down like nobody business. You can get out. Why you want to be stationary? Why do you want to hold the stock and see it go down 20, 30, 40, 50%? Why? You cannot sell it? Can what? You can sell earlier, right? Okay, the longer you take, the worse it becomes. Right. So the exit plan is very important. So a lot of people focus so much on buying, right? They forgot how to exit. Take profit, sell, cut loss. These two must be your exit plan must be there one. Okay. It's just like some emergency plan, right? You got fire exits. You don't go and build a place where the exit have no safety consideration. There's only one small door and 100 people need to squeeze through when there's a fire. Of course, you know, that's plan to fail, right? So same thing when anything that involves risk, you must have a contingency plan. If things don't go according to plan, which they will, what are you going to do? What if the stock suddenly go stage 4? What are you going to do? It will happen. What are you going to do? Right? So it's not about being fearful, right? Oh, yeah, it may go down a lot. That's why I don't want to buy. Okay, it's not about that. It's about how do you manage your risk, right? We understand the concept. Yes, it's better to buy a stock going up. It's better to buy a stock in stage 2. Yes, it may look higher than where it was, but the idea is if we can, the tendency of the stock going up further in the next few weeks or months is higher. So it's better to go with the flow than to go against the flow, right? We started the session that way. Okay. So it's more about if you want to do that, then how do you take care of the contingency, which later we will talk about the selling part. Okay, so now let's go back to this example. All right. Yeah. Let's put in some of the concept we have learned so far. Okay, what is this stage? Two, right? And the momentum reading is here. It's about 184.21. Actually, maybe not so high, 84, 84.21. I think the cursor was somewhere else, right? Which is rather high, okay? Which is rather high. So there is momentum. There's technical momentum. And it is in stage 2. Okay? You don't have the fundamental momentum in this case, right? I didn't show you, right? It's not in this chart. So based on the concept that we have learned so far, okay, are the rules telling us to buy or to wait? Just based on the rule, we don't talk about our feeling. We're going to talk about, I think the share price is high. I think, I don't want to buy. It's to buy, right? That is the rule, right? Okay. So this is what happened. After 130, the share price chonged to 160. And the momentum went up even higher. Right? Still stage 2. Okay. Then when you look back, this 130 doesn't look that high anymore. Correct? You know why? Because this is also another human construct. Just remember when we invest or trade, right? There's a lot of biases that's within us, right? You know why it looks scary? Because the chart is at the top right-hand corner and there's this invisible ceiling. Or it's not invisible, right? It's this ceiling. So it's almost like it gives you a visual concept, right? That it hit the top of the box, it must come down. Correct or not? Correct or not? Okay. But let me ask you a very simple question. To the stock, does this ceiling exist or not? To the stock, does this ceiling exist or not? This visual ceiling, this box, does it exist or not? All right. This ceiling is a human construct. Understand? This ceiling is the ceiling that's limiting your visuals. Okay. Yeah. So the stock has no such concept. This ceiling doesn't exist one. Okay. You are being tricked. Your eyes are being tricked. There are a lot of eye tricks. Right? There's even a museum, right? What trick eye museum? It's true. So even when you do all this investing training, there's so much biases that you don't even know. You're being constrained by all this invisible stuff that only apply because of certain limitation, because of a screen limitation size. Yeah. You see, what happened when the stock price go up higher, then they just shift this ceiling higher, just push this higher up. It doesn't exist. It's just a visual impairment. Yeah, I hope you all can start to see all the problems we have when we do our own trading investment or analysis. It's so many of these biases that exist. Right? Simple things like this we also don't know, right? That actually affects us a lot. Okay. How about this? Next one. Right. Let me rephrase again. Let me ask the question better. Okay. Based on the rules that we learned so far, is this a buy or wait? Buy, right? Why? What stage is this in? It's a stage 2, correct? It's momentum. Green color. Bar. Okay? It's a buy. It's still a buy. Can it go higher? Possible. Can it go down? Can it go down? Is it possible that it can go down from here? Yes, it's possible it can come down from here. But do we know? We don't know. Okay, but the principle or the concept saying that once the stock has momentum, the tendency is to go up. But of course, we can always prepare for the other scenario. Okay. So let's say you buy at 23, this is what happened. It looks high just now, continue to chong to $30 in a span of 2 months. $7 off $23. That's about 30%. 30% in 2 months. Okay? When people think that this is high. Again, that human construct, that visual impairment exists. There's no such thing. There's no such line in real life. Okay? So this is a concept that I think a lot of people cannot accept, okay, because it's not natural. I understand that usually investing or trading to do it properly, right, is unnatural, and usually our biases will keep coming in to cripple us. That's why it's important to have a strategy, important to have frameworks, important to have principles and concepts to guide us to do the right thing. Yeah, otherwise, if we use our gut feel, right, we will always fall prey to our biases because biases makes us feel comfortable. But what is comfortable is usually wrong one. Because we are not designed or evolved to do investing and trading naturally. It's a very unnatural activity, let's be honest about it, right? If it's so natural, a lot of people make money already. So why a lot of people lose money is because they cannot overcome their biases. Okay, they keep crippling themselves, right? So yeah, cases even we have like graduates like this example. Okay, this was during the inflation period. So inflation period, a lot of stocks were down, tech stocks were down especially, right? But the momentum concept or the momentum strategy tell us, hey, go commodity. So you can see this list of stocks, right? Mostly are commodities, especially oil and gas stocks. And they were breaking new highs. They were very close to the 52 weeks high, right? Which is 1 year high. So even this guy graduated also feel very uncomfortable. Sure not. How much upside can it be when it's so high? Right? This is a very natural thing. As I said, this is human. Okay. If you don't feel that it's high, is something is wrong with you. Okay, you're very unnatural. It is high. Usually momentum stock looks high, right? And it is normal. It is okay. Right? So that was the discussion was somewhere in Feb. I think about 2 years ago, during the inflation period. If you remember, the Federal Reserve was hiking rates, right? Tonight, they're talking about cutting rates, okay? So that was a reverse. And commodity stocks were doing very well because of inflation. And then 3 months later, this is in May, okay? Just look at some stocks, right? Like CF Industry, it was $73 in Feb. It become $100 in May. ConocoPhillips was 93. It became $100 as well in May, in 2 months. Suncor Energy was 29. It became 34 in 2 months. Right? So you can see it can run quite a fair bit when it happens. Okay. And it's not constrained to stocks. Like Johnson asked, can this concept work in Forex? Maybe I ask you all, can this momentum concept work in Forex? Cannot. Can. It works in Forex as well. Okay. It works in bonds as well. Right? It works in everything because anything that is traded by humans have these biases that is embedded in the prices. Okay. Can it work in property market or not? Can it work in property market or not? What do you think? Physical property, COE. Yes. Okay, why this momentum concept exists? There are many explanations, but let's talk about that. Okay, let's talk a little bit about that. Okay, let me ask you this. when property prices, okay, where do you see the more people in the showroom? Okay, when property prices are high or when property prices are low? When do you see more people in the showroom? High, right? So when property prices are going up, more people want to buy or less people want to buy? More, right? So when more people want to buy, what happened to the price? What happened to the price? It go up. That's why the momentum exists. Right or not? Like China now, property prices are down. More people want to buy or less people want to buy? Less people want to buy. So there's not enough demand, too much supply. What happened to the price? It drop further. Momentum. Right or not? Does it work for gold prices? When gold is at 1,200 versus when gold is at 2,500, which one more people want to buy? When it's higher, right? Does it work for crypto? Does it work for Bitcoin? When Bitcoin is 1,000, it's a scam. When Bitcoin is at 60K, wow, this is a damn good investment. Correct? Can you see? It's human psychology. It's that mass psychology that doesn't make sense. Okay, but that's why momentum exists because of we humans. We created the momentum. And what we're doing here is to capitalize on this human behavior that is very persistent through history, very persistent through generation. It doesn't change until the day humans don't participate in the market. It's all AI or all robots. Then maybe momentum will work. But as long as humans are making this investment decision, the momentum will always exist. One, because a leopard doesn't change its spot. We don't change our genes. That is how we behave. But we have to make it smarter. We have to be smarter than masses, right? We have to use that mass biases in our favor and we capitalize on that. That also means that you must act differently. You must act opposite to what most people do. Okay. Yes, you go with the flow, you go with the trend, but you must have an exit plan. Right? Most people to talk about this, right? Even though momentum concept looks like you're copying other people, right? Okay, you're just adding to the frenzy. Correct or not? Okay, but it's not true. Okay, I can tell you, right? When a stock goes up, most people will say expensive or anything, they won't buy first. Okay, then it go up further, then they feel that FOMO already. There will be at one point that people will start to come in, right? So then they buy, then may push up a bit more. Okay, this is the dangerous leg because they FOMO, they buy a bit, they make some money. What do you think they will do next? Let me ask you. First of all, when they go up, they say expensive, they didn't buy. Then it went up further, they FOMO, they scared they don't buy, it go up higher, so they buy. Then they make some money. What do? They buy more, right? And then that's where it come down. Okay. So what is dangerous is not momentum. What is dangerous is they go in really late, they make some money, and they become aggressive at even a later stage. That's how they do some money. It's not that they didn't make money. They make money. They make some money. But the greed comes in. And then they take an outsized risk with no exit plan. And that's how they destroy themselves. That is dangerous. Yeah. So the idea is you should follow the momentum, but you must know how to get out. Okay. But the trend can last longer than you think is possible. Right? So you still can make a lot of money before it comes back down. Okay? So you need to be smarter than the crowd. Right? You need to make use of them, right? You need to make use of the masses to help push the share price up. Otherwise, how are you going to make money? Okay. But you need to know how to exit because most of them, they don't know how to exit, right? And they will get aggressive at the wrong time. Yeah. So next thing we talk about all-time high. That means the stock has never traded at this price before. It's the highest ever price it has achieved. Okay, it looks something like this. Right, this was the highest point made. The share price came down. Then after that, it tests the same point again. Okay, what do you think? Okay, based on based on our rules and concept, what should we do? Based on our rules and concept, is this a buy or a sell? Buy, right? Why? Okay, if you can see this small part, this is still a stage 2. Okay, because it's the zoom out chart, this is like a 6-year chart. Right? Just now the chart that we see is like 1-2 years only. Right? So this is a zoom out chart. So the trend is a bit different. Okay, so it's a bit smaller. So this is still a stage 2. Momentum is still high. Okay. Yes, based on concept, it's still a buy. Right? And then it went up another 56%. Okay. I just want to show you what is possible. Right? There are many examples like this. A stock that reached all-time high is not a bearish sign. In fact, it's opposite. It's a bullish sign. Okay, it's a bullish sign. Same concept. This is still a stage 2, correct? Momentum is also high. Test the all-time high. This is a UK stock. Okay, works anywhere. Right? Share price went up another 38% after it breaks high. Another one, Aristar Network. Okay, there's also a stage 2 here. Right? Then there's this all-time high. And after it went another 93%. Okay, these are not small numbers. These are big numbers within a year. Okay? And is NVIDIA in stage 3? Don't know. Later we see. So should ignore support resistance trend line. It depends on the strategy you use. Of course, today we are talking about more broad-based, right? It's more important to understand the big concept first. Okay, there will definitely be some reaction at the support resistance. And it also depends on how much allowance you give for the price to fluctuate. Okay. There are different nuances to the strategies. Okay. Yeah. I don't have time to explain every single step, but just understand the broad concept is more important at this point. Okay? Can I? All right. So after we talk so much, when is the best time to buy a stock? This one you get it wrong, then I cannot help you. It means you're not listening. Correct. Stage 2. Okay, good. So your job is to find the stock, whether it's in stage 2. As long as in stage 2, of course, there are other criteria, right? It's a buy, you should still go ahead. You should not be concerned about, wow, it's all-time high, it's like, or it gone up so much already. You don't know one. It can go up a lot for a long time before it reverses. Okay? Next important thing, when to sell. Okay? This is a common handicap for most investor trader. And there's always one dangerous mindset. Buy and hold. Let me ask you a very simple question. Is every stock worth to hold for long term? Is every stock worth to hold for long term? No, right? Obviously. So if not every stock is worth to hold for long term, means that you must know how to sell at one point in time. Okay. Next question. If I make a loss, I buy here, share price went down. Does it mean that if I hold long enough, share price will go up? Also no, right? Okay, so a lot of all these, I keep poking a lot of all these assumptions today is because these are common assumptions that people have and commit all the time because it feels good. If they buy, they lose money, they believe that they don't want to sell it because selling it means they realize a loss. And they always feel that if I don't sell it, I got a chance that I can make my money back. Okay? And then they will tell themselves, buy and hold, right? In the long run, stock market goes up. Yes, in general, but not all stocks go up. Okay. Not all stocks go up in the long run, right? I think there are a lot of all these biases again, loss aversion bias is what they call. Okay. You don't want to realize the loss. Then you find excuses why you are holding the stock to convince yourself that imaginary things, not reality. Reality, you should not be doing that. Okay. At one point, you must know when to sell. Yeah, give me an example. Very dangerous. Okay. Long story short, basically, Nokia phone used to be the most popular. During the peak of the Nokia era, I can tell you that a lot of analysts will say that, wow, this stock very good lah, got moat lah, got more than 50% market share lah, right? All this kind of thing. This is a good long-term buy and hold stock, blue chip, innovative company. Okay. Bring you back in time, definitely you go and dig. Confirm one. Analysts will be very bullish this stock, right? And what happened? Yes, the stock done very well, then crash. We all know lah, now Nokia is not popular anymore. Okay. And imagine someone bought in a frenzy, okay, middle of the frenzy, bought here at $20. Today the share price is at 355. And he bought at year 2000, and now we're in year 20, okay, here is year 2023 lah. The person waited for 23 years, the person is still losing 70%. Now 70%. Okay. What do you think? Should the person continue to hold Nokia stock until it goes back to $20? Why no? But then the person say, yeah, but sell at 355, I'll lose a lot of money, And I already waited for 23 years. That's called endowment effect. Okay, because you feel that it's worth more than what the market is paying. So that's why you don't want to sell. Right? Okay. The idea is, yeah, there's another concept I want to remember. Okay. So let's say now Apple is the hottest, right? Okay. Yeah. Not say the hottest, but let me ask you, yeah. Scenario A is that continue to hold Nokia. Hopefully share price can go up. Scenario B, sell Nokia, buy Apple. Which do you think will recoup part of the money faster? A or B? B, right? Correct or not? But why most people don't want to do that? Why most people will continue to hold a losing stock? Even though they know that fundamentally is impaired, the chances of recovery is very low, but they still prefer to hold on to the losses. Because they don't realize the loss. Yes, because you feel the pain. But that's the other problem. Every time if let's say the most investors, they won't sell their losses, right? For Nokia, for example, right? Every time they open their brokerage account, right? This will remind them. This will remind them for 23 years. Isn't it more painful or not? The moment you just sell it, right? The burden is gone already. The stock is out of your portfolio. You don't even see anymore. You give it enough, like a few years down the road, you don't even remember you bought the stock. Why do you want to hold that pain and get reminded every single day for as long as you hold it? It doesn't make sense. The pain is worse. It's a slow death. Okay, you sell it already, you move on already, right? Yeah. Okay, don't collect heartbreaks. Don't go and collect mistakes and hold them forever. It's okay to hold good stocks for a long time, but don't go and hold your mistakes forever. Okay, it's not good. It's not good for your mental health as well. And you will it will affect your confidence going into the next stock. Correct? Okay? Don't collect too many of these things. Get rid of them. That's why you need to know how to sell, learn how to sell, be more ruthless in your selling. Yeah. How about Warren Buffett? Warren Buffett got losses or not? Warren Buffett got losses or not? Sure got, right? And when he lose, does he lose thousand, millions, or billions? How? Billion, okay? Not millions, billions. I'll give you an example. Yeah, don't let me. Can read the title. Warren Buffett may have lost 1.5 billion on Paramount. It's just one example. Okay? Does he sell or not? Does he sell or not? Even though he knows that he's going to lose billions, does he sell or not? Yes, he sells. And yet he's the guy who said that I'm going to hold the stock forever. But he didn't say hold your mistakes forever. He didn't say buy and hold mistakes. You'll be wrong. Not all the stocks you pick will be right. There'll be a lot of mistakes one. And the earlier you realize your mistake and you get rid of it, you sell it, the better it's going to be. Investing is about correcting costs. It's not about knowing exactly what's going to happen. No, because nobody exactly knows what's going to happen next. Right? Given more information over time, then you realize something is wrong. Then correct costs. Okay, so I think this is the biggest mistake investors make. They always don't resolve their mistakes. Okay, they hold it to the grave. Right? Not worthy one. So learn from Buffett. Always remember, even if he make $1 billion mistake, he will sell, he will realize it, and then he will use that money to go and invest something else. That's why he cleaned out his portfolio. Okay? So this is just one example. I'll not go through BlackBerry, all this. And this is another statistic to tell you that, to show you that, in fact, more than half of the stocks is not going to do well. That means your hit rate actually not very high one. Your chances of getting a mistake is higher than you get a good stock. So the more you must learn how to get rid of them. It's okay to make mistake. It's not your fault. You've done your due diligence, you went in, the next best thing is to correct course, not to stay where you are. Okay, so learn to sell. You don't want to be wrong and hold it for a long time. That's the second mistake. That's even deadlier. Okay, so now, how do we know when to sell? Again, the context is short-term, short-term trading, not for long-term. This strategy that we're discussing today is short-term. Okay, when do you sell? There are different methods again, but let's go through one simple one. Sell when the share price go below the moving average. Remember, we say that the share price must be above the moving average to be considered stage 2. Okay, so when the price go below moving average, that means that there is a chance that the trend has reversed. We don't know, but there's a chance. It's good to sell. Okay, it may also mean that stage 2 is over. It's good to sell. Okay, that's the one simple exit plan. For example, let's just follow the red line again. This is your 200-day moving average. That means when the share price go below the red line, you will sell. And this point is $280. You wouldn't need to hold the stock all the way down. Stage 4, stage 1, wait and wait, still price never go up, wait. Got a bit of sign here, maybe here is a bit stage 2 beginning, but it's still pretty much underwater, right? Now it's $80. Think about it, getting out $280, save 2 years of your time, You could have used the capital for something else in that 2 years instead of holding all the way down and still haven't seen daylight yet. Okay? PayPal, same thing. Here's exit. Because the price went below the red line, the exit point would have been $265 instead of holding all the way stage 4 down, very painful. And then after that, no activity, stage 1. And stage 1 lasted for 2 years already. Still counting. How long? Don't know. Stage 2 haven't started yet. Estee Lauder, you have got out at the start of 2022 at $310. Instead of holding it down, people say low, cheap, go lower, still go lower, make new low some more. Right? $88 now. So idea is here. The earlier you will have a exit plan and you exit is better. And you hold on to your mistake. Or same thing, if momentum can help a stock go up, momentum can also help a stock go down. Okay, it works both ways. Selling is also about taking profits. And let me explain to you how it works. Okay, this example we use the blue line, right? This is a 100-day moving average. So for example, you bought here. Okay, stage 2 momentum was still high, for example. You don't know whether is it going to reverse or not. Okay, your job is to hold the stock as long as the price is above the blue line. Okay, as the share price go higher, you realize that the blue line also start to climb. So in trading, this is what we call a trading stop. Okay, that means you will protect more of your money as the price go higher. Right? The reason why you don't want to like set the profit target is because you don't know how long the momentum can carry the stock. You don't know how high the share price can go. You want to give enough room for the share price to fluctuate. Okay, and only take the real signal when the share price reverses. So you must give breathing room. Right? So you can use this moving average, for example, as the share price go up, down, right? You can see that it didn't trigger your sell yet. And then you can chong a lot, then after that come down. You don't know, right? All this movement you can't predict, right? Okay, but you just know that as long as the share price go higher, your profits keep growing. Correct? Just let it go. You don't know how long when you go come down. That day happen. Then you sell it. Okay, then you protected 34% returns. Okay, yes, you didn't sell at this point, but you don't know this is the highest high until it happens. Not your fault. Because you're supposed to give some room for fluctuations. Okay, of course, how much room to give fluctuation, it depends on the strategy as well. Okay, another example, right? You might not get in at this point, might not be early. This is somewhere in the middle, for example, right? But it's still stage 2, momentum is still high. Okay, so let's say you get in here, and same thing, your job is to continue to hold. If the share price is above the moving average, you don't know how high it will go until the day it comes down. Okay, sell, 52% return. You didn't even join at the early stage. Of course, your returns will be higher, but 52% over a period of 6 months. Isn't it good? Yeah. Make use of the trend, make use of the momentum, make use of the masses to push up the price and get out when things change. Okay. NVIDIA, same thing. You may not need to catch the whole trend. Doesn't matter because you can always switch to another stock that is going out as well. Right? You don't need to die must be money from NVIDIA. But in this case, you can still make a 75%. Let's say you got in here, right? Which happened to be quite early. Okay, when the trend started to move up, momentum was strong. And same thing, you don't know how high it go. You just continue then it happened. Cut, sell. So in this case, cut already, it went back up. So be it. Right? You never know. Okay, you can also go this way. You also must be managing your risk. Okay, so you follow the principle, follow the rules. Okay, so the idea that I shared with you today is more like uh what I call the turbo stock. Okay, turbo stock typically have these characteristics. Of course, the devil's in details, but I explain to you the concept pretty much the way it is. Okay, and all these principles are there to guide us to make the right decision whether to buy or sell. Okay, so it involves the fundamental momentum, having that revenue or earnings growth that will increase the chances of having a gap up during the next earnings season. And there must be TA momentum, means the share price are moving up. Okay, if the share price is not moving up or have the energy, then there's no guarantee that the share price can continue to go up. Remember, stage two is the best time to buy the stock, not any other stages. Because any other stages is just a waste of time and can be risky, especially in stage four, because where it's low can go lower. And once you get into the position, you just need to make sure that you sell when the trend reverses. Okay? You take profit, you cut loss the same way. Right? So once you sell, look for the next one. And the cycle just keep going. It's a very simple methodology, but I can tell you a lot of simple things in life can be very hard to do, right? Eat less, exercise more. Very simple, but why most people won't do it? Because again, it's against that human nature. Right? It's not natural. We prefer to like laze around and eat, right? Because that's how our our ancestor evolved into what we are today. Same thing, to trade properly and based on this core principle, right? It may sound easy, but sorry, it may sound simple, but actually it's not easy. You are going against your natural instinct. Right? You have to buy higher, you have to sell when you don't feel like selling. Because you may feel that wow, I had to cut loss, or you may feel like yeah, I think you can go up higher, right? So all these biases will creep in, okay, and you keep sabotaging yourself, right? So that's why having a strategy is very important. Okay, nobody use gut feel to make money in the market in a sustainable way. You may make money one or two times, but you cannot make money sustainable for many years to come. Right? So you need strategy, you need principles. Okay. And some examples, right? I won't go through all of them. Let me just maybe let me just choose one or two. Okay, so this is earnings play. No, I think there's a better example. Yeah, this one. Start of this year. I remember this because it was Chinese New Year. Okay, okay, I didn't show the revenue, but this have a revenue or fundamental momentum. And I deliberately buy because I know the earnings is coming. Okay. And it was a bullish market. So the chances of a gap out was high. So I bought 2nd Feb. And then this was the Chinese New Year Eve. Right? Market was still open because US don't celebrate Chinese New Year. Big gap up. Then I straight away sell. Okay. Because I really just wanted the buy the gap up. Okay, so fundamental momentum can also work in this way. Right? Okay, so these are more aligned to what we were discussing just now, right? So you can see these new techniques also had a good run. Bought sometime in end December, sold in June this year, because you can see the price went below the moving average, right? Then get up. Okay, still a good run over a course of, so you can see even though it may feel like at that point in time, right, it may look higher, but the share price continue to run up for a good 8 months. Okay, a good 8 months, right? So don't assume that the share price immediately will reverse. It may run longer than what you think is possible. Okay, Wingstop, also another one that ran quite well. And this one got fundamental momentum as well. You can see. Okay, the results were very good. They have a lot of gap up as well. And this was bought last year, December, sold in July. So this is a span of also 8 months. Okay, 8 months at 54%. Okay, yes, the blue line is a moving average. Spotify, same thing. Also a good run. Also this is 9 months. This is 9 months, 81%. Okay, this one sold was not because it went below the moving average. It's because of the momentum. momentum became very low, energy very low. Okay, so this was a take profit point, right? So these are just some examples. There's also shorter term ones. There's also another swing trading concept, but a straight swing trading strategy, but the concept is the same. Okay, buy in stage two, just that certain indicators are a bit different, right? The entry and exit a bit different, tighter than what I explained just now. Okay, that means that you catch a wave, right? So you buy on breakout, you sell on breakdown. Okay, so you catch this wave. You can see that the number of the period is shorter, and the holding period, basically the you need to catch a wave rather than holding over period, right? Because if by right what we discussed just now, you will not sell because the share price continue to go above, stay above the 100-day moving average. Okay, so there are also different ways that we can go deeper into how to execute the strategy. Okay. So as I said, the devil is in the detail. If you really want to learn how to do trading, okay, how to do momentum trading, how to use momentum to help you make money in a shorter period of time, right? Because a lot of times you can see that the holding period is weeks to months. It's not like years. You catch that part of that wave, that uprun, and then you just sell when time to sell. Okay, so let me just give you some details about what this program is all about. I call it a Turbo Stock Trading course program. And the course itself has 5 days, right? Which will go through actually two strategies. Okay, there are actually two momentum strategies that you will learn. And not just understanding how to buy, sell, how to set up a chart, blah, 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 but also about portfolio management. How many stocks should you have? How do you size your position? All these are also not mentioned in this session. Okay. And so that's the first thing. You get a 5-day course, and I'll give you more bonuses to help you, right? They will need tools. Okay. When you trade, definitely, or even invest, you need tools. And I'm going to give you all these tools. So the bonus one is this fundamental momentum template. Okay. We talk about the rising momentum, right, of revenue. Right? In this case, Spotify also have, correct? It looks like a staircase. Okay. So in this case, the chart or this trading view chart has this indicator, which we can add, and visually we can see it very clearly. But we cannot assume that every stock have this, especially if you trade Asian stocks. Let's say you trade Hong Kong stocks, you trade even Singapore stocks, which have a good run in the last few months. You may not have this. Okay, the data in Asia is a bit sketchy, right? So TradingView may just show you one line flat, like nothing much. Okay, so that's why you need another separate sheet for you to build this momentum template for fundamentals. And I also show you how to get a free data and copy and paste in the template. Then you will be able to see whether the stock got fundamental data, fundamental momentum or not, right? And yes, I also will show you how to set up the chart. How do you get this exponential regression? How do you get the fundamental momentum? How do you add in the moving averages? All this will be taught in the course, of course, right? So the second thing is this exponential regression. Yes, it's an indicator in the trading view, but it's very tedious. Okay, because remember, it's a ranking system. You're going to rank all the stock based on this exponential regression. Right? You're going to rank all the stocks based on this exponential regression. And it's not sustainable, and it's not a smart way if you manually go and tabulate every stock that you're looking at and do the ranking. It's going to take up too much time, many hours every week, because you need to do the ranking every week. Okay? This is not sustainable. And therefore, there's this screener that is being built. Okay, we work with Quant's Cafe. They built it for us. The rules are created by us. He helped to program and code it inside, and he supplied the data as well. Then we will be able to rank it very easily. Okay, then we know what are the stocks that have the highest momentum. Right? Please don't use this because this is last year. Okay. The ranking will change every week, right? So this will give you 1 year of access, right? But you don't need to, it's optional whether you want to continue to subscribe, okay, to this. It is definitely useful. But if you don't want to, I will also teach you other ways how to get the data. Okay, but of course, if you have the screener, it's a lot useful, right? It's a lot easier. The next thing is trade ideas that I will give you on a weekly basis as well, right? I will give you a list. Usually I do it on release on Sunday so that you can place your trade for the rest of the week. So there's also something that I think people may get the idea that, oh, trading means that I must look at the screen every day. Trading means I need to place my trades every day. It is not true. Okay, so my workflow, okay, even trading got workflow. Sounds like work, but it is true. If it's so fun, then it's not it's not proper trading or investing. There must be a workflow. So typically, the trade ideas, because there are two strategies, right? So one strategy, the trade ideas will be released on Sunday. You place the trade for the rest of the week. And then another strategy will be done on Wednesday, right, in the middle of the week. Same thing, the trades will be done on that day, right? And then you just leave the portfolio as is until the next Wednesday. Okay, so there is this cycle or this routine that these trade ideas will be shared, right? So it looks something like this. I'll give you a table on Sunday, for example. Sometimes it's earnings season, I'll tell you, right? Watch out for these dates. Okay, if the season is good, you can even buy before the date and enjoy the gap up. But sometimes the earnings season is not good, right? A few stocks initially gives you, wow, even good results, share price sell down, and then you know already. That's earnings season a bit risky. Then you better sell before the earnings rather than hold through. So there are certain situation that we need to adjust our positions. Okay, so of course, all this will be guided along the way. Okay, and there will be holdings and trades shared on a weekly basis. So same thing with I will share the position that I have, the trading position for both strategy on a weekly basis, right? So the ideas and the holdings will be shared on the same day. Like for example, today is Wednesday. Okay, so today, let me see. Let me show you. Easier, huh? Yeah, so for example, this is what we are doing, right? So today I'm going to sell this CRUS because it's below 100-day, and then I'll buy CLBT, right? And this is the portfolio position last week. Okay, so you can see the the stocks I'm holding, and I'll give you the P&L as well as the average holding period, right? Like for example, GoDaddy is the highest returning one right now at 40.99%, and the stock has been held over 273 days. Okay, so different strategy. This allows a bit more, a lot more room for them to fluctuate using a moving average as exit point. Okay, so these are pretty transparent, right? So I'll show you the holdings and the trades done on a weekly basis. Okay, so you access the trading portfolio. And bonus 5 is the exclusive Facebook group as well as a Telegram channel, okay, that you'll be added into. That's where you get the support, continuous support is for lifetime. There is no recurring in this case. Once you join us, congratulate, then you'll be added to the group and the channel. And that's where we continue to give you the ideas, continue to give you some market updates, as well as you have any question, you can always ask us, right? So it becomes a forum as well, double up as archive of all our trades done in this group. Okay, so these are the things that you're gonna get. Let me just repeat for you. It's the Turbo Stock Trading Program. It includes the course, and the course dates are as such. Okay, it's gonna happen next month, October, 5 days straight. Saturday, Sunday, Monday, Tuesday, Wednesday. Okay, and it's all online, it's all live webinar like what we're doing now, so that you can ask questions directly, right? I'll answer them directly as well. And typically we'll do about 3 hours each session. Okay, otherwise too long you also will check out. Okay, I can do whole day one, but usually the listener is the tougher side. Okay, so we usually split into 3 hours per session over the course of 5 days continuous. right? And you get a bonus one fundamental momentum template. This is where, in case the chart don't show you the revenue growth, you will need this template to help you. Second is the technical momentum ranking. Okay, it's a screener, but it's actually just it's more of a ranking system, so that you know what are the stocks that has the highest momentum, right? This will give you 1 year. Okay, it's optional whether you want to continue after that. Third is stock ideas. These trading ideas basically. These are ideas that I will share on Saturday and Wednesday on 2 separate strategies. Okay, trading strategies. And fourth is you get to see the holdings for both strategies as well, right? And lastly is a lifetime membership on our Facebook group where you can ask questions, you can get the trade ideas continuously and also access to trading portfolio. Okay, everything will be posted there. It's like our uh, uh, learning management, I don't know, archive, knowledge management, knowledge management. Okay, so this is screeners for US, right? Mainly for US market. Okay, there's one strategy. There are two strategies, right? One strategy is for mainly for US. The other strategy is we cover US, Asia as well. Right? Asia mainly Hong Kong, Singapore. Okay, yeah, but most of the trades you realize US will have more, right? Because US have more stocks and US has more volatility. Uh, has okay, volatility may not be a good thing, okay? But US generally has more action, which is good for trading, right? Screener, what happened after 1 year? It's optional whether you want to renew. Okay, you still get trade ideas anyway. Right? You still get bonus number 3 ongoing. But if you want to do your own screening, you want to change the parameters, then you will need to uh, uh renew the subscription because this is done in conjunction with Quant's Cafe. It is not solely by us. So they need to have that recurring in order for them to support the data and all those things, right? Because the data costs money. Okay, but it's not a very big amount, right? Okay, so the investment for this program, you get a 2 complete strategies, you get a continuous support for life, right? And the offer that we can give you for the next 3 days is 2576 in sync. Okay, you can break it down in installment, interest free. If you have attended the QMT course before, those who have attended, you will know, we can less off the amount you pay for, right? Otherwise, it's this 2576 for the next 3 days. We will hold this price for you, right? Otherwise, it will be double of that. Okay, so this is the offer we can give you, and the link is in the comment box. You can just register your interest. You get more questions, you can get back to us. You have attended QMT before, you can let us know, then we can less off the amount, we can check for you, right? What is the exact amount you have paid for? So this is, as I said, refreshing, I believe, right? A lot of the concept you have probably not heard before. Just understand that short-term trading is very different from long-term investing. And a lot of people have committed that mistake of using long-term strategies for short-term position, right? And also don't know how to sell. Okay, very, very important. Okay, yeah. So I hope today has been helpful for you. I hope that is the eye-opener. Right? Definitely the course you will learn a lot more things. There are a lot of nuances that I cannot share with you today due to a constraint of time. All right, but nevertheless, okay, I hope that you have learned something useful. Okay, if you have learned something useful, type yes in comment box so I know. Otherwise, I need to either make it simpler, or easier to understand next time. Yes, okay, thank you very much. All right, so for those interested, you can leave your contact, we'll get back to you. Right, thank you very much. And exciting day today. Market is going to open. I need to do some trades, as you can see, as well as rate cut. Okay. You will know what will happen in the next few days. Thank you. All the best for your trading and investing. I'll see you around. Bye bye.